Now that we've covered the market comparison and cost approaches to real estate appraisal, let's dig into the last approach, the income approach. Here, an appraiser uses a property's rental income to set its value. Property appraised using the income approach includes apartments, offices, industrial buildings, commercial units, and other income-producing property. This can be done in one of two methods under the income approach: the gross rent multiplier method, GRM, and the capitalization method. The GRM method uses the market rent as determined by a survey of similar properties, which is then multiplied by a factor, the GRM, to arrive at a value for the subject property. The GRM factor is determined by comparing the subject property to similar properties that have recently been sold. Now let's take a closer look at the capitalization method under the income approach. The capitalization method determines the property's value based on the property's future income and operating expenses. Now the GRM method can use either monthly or annual income. The capitalization method must be calculated using annual income and costs. The first step is to establish value using the capitalization method is to determine the property's effective gross income. A property's effective gross income is the gross income minus vacancies and collection losses. Next, deduct operating expenses from the effective gross income to determine the property's net operating income, NOI. Now, what are operating expenses? Well, operating expenses include such items as property taxes, insurance, security, management fees, utilities, and maintenance. Some operating expenses are variable, such as utilities and repairs. Others are fixed, such as property taxes and insurance. Operating expenses also include reserves set aside for large expenses, such as the replacement of the roof. Okay, so remember that we've arrived at the property's net operating income by deducting the operating expenses from the effective gross income. The third step is to mathematically divide the property's NOI by the appropriate capitalization rate. The cap rate is comprised of a prudent investor's expected annual rate of return on monies invested in this type of property, adjusted for inflation and risk premiums, and a rate of recovery of their invested funds allocated to the improvements. This is also called depreciation. Thus, the fair market value of the property is determined by dividing the NOI by the cap rate. For example, if a property's NOI is $100,000 annually, and a cap rate of 10% is used, the property's value under the income approach would be $1 million. Since we are dividing by a fraction, the resulting fair market valuation will always be greater than the NOI. Further, the rate of interest paid on mortgages and the amount of or terms of the mortgage debt on a property have no bearing on a property's market value. For the purposes of valuing a property under the income approach, the property is viewed as being clear of any monetary encumbrances.